Dollar General announces great expansion plans, Nike reports its latest financial results, and a global chip shortage is troubling car makers. All this and more on this week's Invest Roundup. Hey guys, it's Terry and you're watching another episode of Invest Roundup. AstraZeneca's vaccine is back in use in most countries and was proven safe in clinical trials. Some countries, however, are still holding back. In the US, people are abuzz discussing the latest stimulus checks and cancelled student loans. Meanwhile, Tim Cook is scheduled to appear in court to testify in Apple's battle against Epic Games and their game Fortnite. I guess we can call it an epic battle? Get it? No? Forget it, let's get into this week's news. Disclaimer! Whatever stock or news we talk about is not a recommendation to buy or to sell. These are all just news we deem important, things we believe you need to know if you're invested in the stock market or if you intend to invest. First news item, why are investors dropping Dollar General? Who doesn't love a dollar store? I mean, storage bins and closet organizers for $1? How's that for sparking joy, eh? Anyway, it looks like this dollar empire is just about to get bigger. Because end of last week, Dollar General announced that they're going to open over 1,000 more stores and remodel 1,700 others this year to create much bigger spaces and widen their product offerings. I know, this sounds the exact opposite of what big guys like Walmart, Target and Best Buy are doing. They're now reducing the store sizes and expanding their online business. But let's keep in mind that Walmart and Target are humongous. Even after the remodeling, the size of a Dollar General store will still only be a fraction of Walmart right now. So if you look at it, this size expansion can only be a good thing. Dollar General also has big plans for Pop Shelf, their new brand aimed at higher income customers which sells home decor, beauty items, party stuff, etc. And almost all items cost $5 or less. With all this fuss that's been going on, you would think Dollar General is celebrating at the stock market right now. Well, to quote Chandler Bing, can you be more wrong? Even though the share price have increased about 21% over the past year, all this push for expansion was apparently not enough to offset investors' disappointment with the company's sales and earnings forecast for this year, which is a step down from last year, and the shares tumbled 7.5% last Thursday, the biggest drop in a year. Investors are also apparently worried now that restrictions are slowly lifting, people will have less dependency on dollar stores. But if you ask what we think, we'd say this drop is just market sentiment. Because disappointing forecasts aside, Dollar General is actually doing great. Who are we kidding? We all love a good bargain. Why buy expensive plates when you can eat off equally pretty ones at just $1? Why get expensive socks when you're gonna lose one of them in a week anyway? Their same-store sales have increased by 16.3% in the last year, and their CEO also announced that Dollar General will now be selling more non-consumable items. These items have higher margins than food and will appeal to a broader range of customers. To top it off, the company also said their plan to boost their quarterly dividend from 36 cents to 42 cents. In terms of fundamentals, the company looks rock solid with great growth, profitability, and is also considered a great dividend stock. And at the moment, they are almost at fair value with an intrinsic value of $187.20. Second news item, Nike faces major shipping issues which is costing their share price. World's most popular sports shoe brand, Nike, may have recently revealed the neon bright Nike Air Max 270. For real, people can spot you in those from a mile away. Unfortunately though, things are not looking so bright in the latest financial announcement. According to CNBC, the brand posted a mixed third quarter results last Thursday in their revenue and earnings. Well, I guess in a way the results were kinda colourful. Revenue reported was more than $600 million lower than estimated, which caused the share price to drop by 5% as of Monday. Nothing tragic because it's been gaining 103.5% in the past 12 months. What's interesting though is that these investors have ignored the fact that Nike did beat the earnings projection by a rather big margin. From last year's earning of 53 cents per share, Nike's per share earnings this time round is at 90 cents versus the 76 cents projection. Anyway, a 5% share price dip might be the furthest thing from their minds right now because the brand is now plagued by problems a lot more significant. In the last few months, Nike's sales growth has been hurt by widespread port congestion in the United States on top of a global container shortage and a truck driver shortage. In North America, revenue has dropped 10% year over year due to shipment delays. And in its Europe, Middle East and Africa region, Nike's sales in their physical stores has also dropped significantly. Luckily, it wasn't all bad because in China, sales have climbed 51% and Nike's overall digital sales have increased 59% in the quarter. Although the global health crisis is still not over, Nike said it anticipates lockdowns will start to ease in Europe in April and delivery situation will improve soon. Analysts have also weighed in and affirms that Nike is more than capable of overcoming the hiccups quickly. That said, Nike might still have their work cut out for them. Last week, Peloton and Adidas announced that they would soon be collaborating to create a new apparel line which promotes well-being, inclusivity, and community, which, considering the world's political situation right now, is a great premise. A major sports brand, a major exercise platform, and a powerful statement. Good luck, Nike. Despite the drop in share price, it seems like the hot stock is still overvalued by 30% from its intrinsic value. The good news is they are considered a solid and low-risk investment for now. You know what else is hot? Me. Okay, not really. But the news that we deliver to you every Wednesday sure is. So, it'd be great if you could hit that subscribe button, turn on that notification bell, and give us a small hand in growing this humble little channel of ours. Now, onto the last news item. And finally, we see how a global chip shortage is now affecting major automakers worldwide. You folks ever heard of the term perfect storm? Well, that's exactly what's happening right now in the computer chip industry. Thanks to a series of unfortunate events, even Lemony Snicket himself did not see coming, the world is now suddenly plunged into a chip shortage crisis. Here's the 411. At the start of the pandemic, when less people were buying cars, car companies started to cut down on the chip orders because they were cutting down on production, while at the same time, people were stocking up on game consoles, laptops, and smartphones for remote working and entertainment. So naturally, major chip manufacturers switched from producing car chips to making chips for laptops and smartphones instead. The problem came when car production started to pick up again recently, only to find out it'll be ages before they can get their chips because production is not able to keep up with the demand. To make matters worse, there was a fire at RENESAS Electronics last week, one of the major automotive chip makers in the world, which have severely delayed production. And factories in countries with extreme cold weather are now battling the weather to get the production going. Car makers around the world are starting to hit the panic button as they realize business is not able to go on as they had hoped. And major car makers like Ford, General Motors, and Stellantis, aka Fiat Chrysler, are now making their cars with missing parts. Toyota, Honda, and Nissan have even suffered major losses in the stock market this week after investors dumped their shares, hearing about the fire in RENESAS. The good news is, looking at these companies' performance, this should be nothing more than a fluke, and once they are caught up on with the chip supply, these car companies remain relatively stable investments. CEO of Qualcomm, another major chip maker, even said that he is confident this crisis will blow over soon and improvements are underway. So, those are the 3 important investment news we had to share with you this week. Once again, we encourage you to get more information. If you'd like to act on any of the companies we shared about earlier, comment below and tell us what you'd like to see on Invest Roundup next week, and share this video with your friends, especially those who are invested in the stock market. We'll see you next week.